Welcome to another week of the Educated Home Buyer Live with Mr. Josh and myself, coming at you a little bit early on this Wednesday, coming in at 4:30 instead of our regularly scheduled time of 5 p.m. And if any of you were confused, looking online, seeing this coming and saw 5 a.m., that's because Jeb screwed up. I put it that we were going to come live at 5 a.m. this morning, and little did I know, I didn't see that until tonight. But my kid has a soccer game. My oldest has a soccer game, so I'm trying to make part of that. And so we're still trying to give you the full hour.
The early risers were excited. They thought they had something to entertain them at 5 a.m. this morning.
I was up at 5 a.m. I was just not on YouTube, talking charts and all that good stuff.
Jeb, we could live stream. I could grab the Osmo and we could just follow you around at the gym at 4 a.m. It would require me to be awake, which was not going to happen. But I could just follow you around, and it was a day in the life of Jeb.
That it would be you'd be bored. I mean, the first hour you'd probably be entertained. After that, actually, maybe the first 2 hours, because my kids would be running amok. You'd hear me yelling at the kids, like "Get ready!" all this crazy stuff, and then after that, it would be really boring. So, a lot like the show, Josh. Quite boring, in fact. After 5 years, we are not any more entertaining than we were 5 years ago. So
Untrue. We're highly interesting.
All right. So before we dive into charts, the big news, I guess right now, right? The Fed came out today, held interest rates the same, which was more or less anticipated. That was the expectation in the market. Couple minor changes. The bond market took it, in a positive way, and we saw the 10-year pull back a little bit, and we're now sitting in the low 425-ish.
Rounded up to 425, which is
so
good.
425-ish. And we're going to talk more about that. Josh has a quote from us, for us rather, from Mr. Powell himself. And, that's it. That's it. That's all we got.
Summed up the entire meeting and press conference in one slide is all you need.
There you go. So what we're going to do is dive into these charts. If you have questions, start throwing them in the chat now. Let us know where you're watching from. And as we come out, we will, give you a shout out if you put in where you're watching from. And then we'll also get to your questions as we always do. So, Josh, let's take a look at the charts right here. So this week we actually saw a bit of an uptick in inventory, up 2% this past week, now sitting at 656,000 single-family homes for sale on the market. That took us from 642 last week, just shy of 656 this week, 655, 626, getting closer to that peak that we saw last year of 739. My guess is we'll probably hit it within the next 60 days or so, just based on more and more inventory coming to the market. Huntington Beach saw an increase, Orange County rather, saw an increase of 2.16%, taking us to 3,423 homes. Haven't had that many homes on the market in Orange County since back in November. And then Huntington Beach up 2.83%, sitting at 247 homes. We haven't been that high, Josh, actually since last October. So inventory continuing to come to the market, which is a positive sign for buyers. What are we laughing?
You said I've been that high since senior year of college. What are we talking about here?
I haven't been that high since this past weekend. No, inventory hasn't been that high, Josh. Come on.
Mind in the gutter. I apologize.
It's all good. New listing. So new listing continuing to climb, 68,000 new listings this week, as you can see, compared to where we were this time last year, considerably higher, which is a positive thing, especially for this time of the year, because it's kind of sets the precedent of what's likely to continue coming. Home prices, let's see here. Median price of this week's pending sales, $390,000. Which is unchanged for the week and from last year. Home prices essentially been averaging up about 2% year over year. Home sales, rather, 66,000 new pending contracts for single-family homes. That's up 4% for the week, and even with last year for the first time in months. And then lastly, Josh, price cuts. Price cuts are what's trending out there on X and a lot of these sites. currently sitting just over 34% of homes have some sort of price cut in them, or on them rather, which is the highest we've seen in the last 10 years or so for this time of year. Is it something to concern yourself with? I don't think so yet, but it's something that we'll continue to follow. And the trend continues, at the pace that we've seen, then maybe it's something to monitor. But I think the majority of these price cuts are in markets that haven't been moving. And so as we dig in a little bit deeper into the data over the next couple of weeks, we'll have a little bit more insight on that. So with that, Mr. Lewis, I thought this chart was interesting, just in the way that it's laid out. So just shows existing home sales, but then it's adjusted for population levels. So once you factor in population, existing home sales are basically pretty close to all-time lows, taking out the early 1980s, Josh.
So something jumps out at me. So if you look there where we hit the top of the green bar just prior to the crash, this isn't homes being built. This is in time because everyone qualified, no matter how bad your credit, no matter how low your income, no matter how little money you had to buy a home. If you were willing to sign for the mortgage, you could buy the house. But if we did this new home construction year by year, adjusted for population, at that same time, we were overbuilding. Affordable 40% in the next 14 months. And it's just a very different time.
And so, guys, if you're watching right now, let us know if Josh or myself are going in and out on the internet connection. I see Josh kind of freezing on my side, but I don't know. A lot of times it's me as well. So let us know. Make sure you can hear us and see us, and that all is well on that front. Crazy to think that we can't get a decent internet connection. But Josh, what is Mr. Powell doing here? He looks to be a little sad.
This was the quote that summed up his entire meeting and press conference and everything. He says, "I don't know anyone who is confident of their forecast." So this makes me feel better. This is a high-level economist, probably the number one chief economist in the United States, has no idea what's going on, and it makes me feel better about our prognostications here and our hopes and dreams and expectations of being able to know what's
that's
coming
the
next.
guy you want leading the Fed right there. The guy's not confident in their forecast.
Yeah, we got a forecast. We're doing some stuff, but we're not confident in it. That's what we took from today. So this 4 out of the 8 meetings annually, we get a dot plot, the summary of economic projections. This tells you what the voting members, and I don't think just voting members, I think everybody gets to put theirs in. So everyone on the Fed gets to put this in, and you can see very, very little change. If you understand how to read this, you'll see that they're a little bit more hawkish for the rest of the year, thinking rates won't go down as much as they thought previously. But then they look to 26 and they go, well, we're more dovish. We think 26 is going to be better than what we had previously thought. So big giant nothing there. Through this in, Jeb, this is a 5-minute chart of just what happened from yesterday through today with the bonds. So you look at this and you go, well, that is fantastic. We got a monstrous bond rally, but that is from worst part of the day was at 432 to end of the day at 425. And it all came there pretty darn quickly. And that was the only thing to me, Jeb, that was interesting today about the Fed meeting and announcement is they are slowing the pace of the runoff of treasuries. They're not slowing the pace of the runoff of mortgage-backed securities that they own, but they're going to be reinvesting less of the treasuries that run off every month. So there will be less buyers in the treasury market. And that is really right when he announced it is that big red candle, and it got a nice improvement. It's really the only reason for the rally. But what you're going to see is when we zoom out and look at the chart of the daily for the last 2 months, we're still very well much within the range. So didn't get anything earth-shattering that moved the market to today one way or the other. So this, Jeb, I thought was interesting. This is how would you rate the condition of the national economy right now? And it's a net rating. So 0, the sort of the middle, like for every one person that says things suck, there's another one that says things are good. If more of them think things suck than think it's good, you get the orange. But we happen to notice there from January of 2017 through January of 2020, coinciding with the 45th presidency of the United States, everyone thought things were great, or at least the net rating was largely positive. The takeaway here isn't Trump awesome. It's that it coincides when you see the big run up there. You probably can't read this up, but the run up from inauguration day or election day through the tax law signed, that was where everyone said, hey, we're getting tax cuts. Everyone felt better. And then it basically stayed at those levels until COVID fell off. And then now everyone hates everything. And that could just be social media. But interesting there in that right now, those tax cuts are up for renegotiation. And we're going to see how many of them stay. And if we can get a net positivity. This is really, Jeb, this is, it's Civics, CIVIQS. They do a weekly consumer sentiment report, much like the University of Michigan does. So I thought that was interesting here. Also interesting, Jeb, we talk about inflation because it goes a long ways towards telling us what's going to happen with interest rates going forward with that University of Michigan consumer survey. So the most recent one, the projection for the next 1 year from now is consumers expect 4.9% inflation. I don't know that I got the chart in here, but if you look where we're at, we're pretty solidly in the mid twos, whether you pick core or headline CPI or PCE. So this shows you what actually happens CPI wise going forward. Consumers are very, very bad at projecting what is going to happen with inflation, but they're very pessimistic right now. And the point of this chart is every time we hit one of these high levels, we've seen CPI do the exact opposite and drop. So a contrarian indicator.
Well, Josh, I think it's important to note, like on that inflation front, like we get a lot of comments, people commenting on inflation on the channel and in lives and in different things. And I mean, and this isn't a dig on anyone, but the reality is they don't understand inflation. They think that once prices are high and they stay high, that inflation is still there. And that's just what prices are at that point, right? Inflation is the rate at which things are changing. And so people think, well, because my car, prices suck and eggs are high and all of these things and they stay high. Well, eggs isn't a good measure because it keeps bouncing up and down. But the reality is, like, once prices are high, people have this idea that, well, it just sucks. Inflation is never going away. And it's like, no, that might just be the new price until we see deflation or disinflation or whatever. So the reality is most people don't even understand what inflation is. So surveying them on it is probably doesn't go too far.
And asking them for a precise measure of what they think it's going to be over the next 1
I think it's going to be 5%.
Yeah, I'm going with 5.2 is my guess. Yeah. This, Jeb, is if you bought in 1985, you invested $10,000.
I was 5 years old.
Well, you should have done it anyways. You should have had $10,000. You shouldn't have been lazy. You should have been out mowing lawns. You should have had 10 grand. And if you invested it, you never sold. You didn't do anything. You were just in the market. And I believe this is the S&P is the way they measured this, but you'd have $1 million today. So it sounds easy, right? Just get a chunk of money, throw it in the market.
That's you are basically speaking every influencer on social media. Like, you should have had $10,000 when you were 5.
You should have had it when you were 5.
Yeah, and you should have been working it.
You should, I mean, absolutely. You were lazy and then you didn't invest wisely. Yeah. Exactly. But the important part of this chart here is when we look at this broad view, you go, oh, look at that. That was easy times, just straight up for 40 years. But you had a nice drop in 87. What do they call it? Black Tuesday. No one liked it. We had people like committing suicide on Wall Street. You had a big dip.
The show has gone to hell, guys. We're done. That's it. The show is over. I'm sorry, guys. That's it.
You had a big dip. And with the tech wreck around 2000, you had another one when we had the Great Recession. So there was a pretty big drawdown. Jeb, we're trying to educate and empower people here. Try and act like an adult for a moment. That's good. So when we actually look at it, these are the drawdowns that you, Jeb, 5-year-old Jeb, investing his $10,000 and never pulling it out, never doing anything crazy. You had a 30% drawdown in 87.
Sure.
You had a 40% drawdown with the tech wreck. You had a 50% drawdown in 2008. And at the beginning of COVID, you had another 2000 or a 20% drawdown. So it's not quite as easy as everyone says. The important part is, you do have to believe in what you're doing, have some risk tolerance, and also have some measures for controlling risk to the downside. Because putting that all in perspective, this shows you here to the right side, we're down like less than 10% year to date. And this average drawdown is 14%. So it is important that you stay invested, whether it's your 401k, whether it is your savings. If you're saving for a home, we talk about that. You probably don't want to be exposed to this volatility. So you want to have it in something more liquid and less subject to market changes. God dang it, Jeb. We got your 4:30 start time messed me up, because where I was going with that is there was another chart that did not get in here. Did we not? We didn't get in here at all.
Yeah, it's we had to start early, but
I did not get it in here at all. But basically, what the next chart was showing if you had done the same thing with a house, and you would have only about $500,000 if you had done it with average price home. $10,000 buying the median home in 1985, which is about $85,000. It's worth about $485,000 today. But the reason why more homeowners had that level of success of just what the market did versus people in the stock market is much harder to sell a home.
Sure.
You need a roof over your head, much more expenses involved in it. So more people just plug in for the long haul, and they don't do crazy things like selling repeatedly. So that is the interesting part. Here's a candlestick chart, Jeb. We are still in this downtrend. We're actually trending sideways between those two yellow lines in the upper half, actually between the 200-day moving average and then that 434 level or so. And that 434 has been a pretty formidable ceiling. We've touched it in terms of the wick 1, 2, 3, 4, 5, 6, 7 times, including today. So big picture over the last 2 weeks, pretty much have just gone sideways. You'll see this by interest rates here. We're better over the week on the third of the year by 0.06, and FHA and VA a little bit less than that. So everything is solidly under 7%. But I don't know if you want to comment on that, Jeb. You had a theory about our nice consolidation here over the last 2 weeks and what may be coming next. You want to share, or want to save that for next week and see what happens?
No, I mean, unfortunately, we don't have the right chart in there. But there's essentially a flag forming on the bottom of that chart, and when you pan out and you see the whole chart, it's a bullish sign for interest rates, or the 10-year rather, to go down, to move lower, and so it's a consolidation in that area. Had we drawn it on there, you'd be able to see it a little bit better. But in my technical analysis background, I have a theory that rates will, or that 10-year is going to move down. Maybe not rapidly, but we're gonna get out of this range that we've been in for a little bit of time. So we'll see if it holds true. So that's to be determined, if you will.
Yeah, absolutely. And we recorded an episode of the podcast today talking about recession, the prospects of recession. Is it going to come, and what it does mean for home buyers? Really, who cares what it means for anyone other than you guys and what you're thinking about in terms of buying a home?
No, good stuff. What else we got here, Josh? We got rates. And then lastly, for those of you sitting on the sidelines, just tuning in to figure out where rates are, if you want to jump on jebsmith.net/rate watch, or take a picture of that QR code, it'll get you on our rate watch list. We'll reach out to you as rates move down, and that way you don't have to watch them every single day. So with that, also a link scrolling the bottom of the screen right now. If you need to get in touch with Josh, get pre-approved, have that conversation, see if you're ready, jebsmith.net/start. We'll make that happen. And let's do this. This past week, Josh, on the Educated Homebuyer Live, we haven't talked about the Educated Homebuyer Live recently. The actual podcast, rather. We talked about lender credits. We get a lot of question on lender credits. How did I do a refinance without any costs? How do you buy a home, or in some cases without having to pay costs? In that episode, we talk about lender credits, how they work. If you're interested in them, have any questions about them, it's a deep dive. I would say a 101 on lender credit. So take a listen at that. It's on the Educated Homebuyer channel. It's also on the podcast. And with that, let's take a look here at some questions, Josh, and get into the reason that people are here. For those of you just tuning in, we came on a little bit early because my oldest has a soccer game. I'm trying to make it, at least part of it, So we're trying to move the time up a little bit in order to make that work. ZL coming in from El Paso. Julie, we got in Western North Carolina. Hopefully you didn't get impacted by the floods there. And is that all the people that let us know where they were watching from, Mr. Josh?
Did we have an El Paso? Thought we had an El
did.
Paso.
We had. I clicked on that one. That was ZL.
Oh. Well,
and I know we
ZL
have,
also thinks that after my comment, we should get a Blue Chew sponsorship. So let's reach out to them and see if we can get the Blue Chew sponsorship in place.
well, what is Blue Chew? I saw that. I don't know what that is.
Well, your wife
So
would like
let's-
you to get a few of them.
Well, let's hear about it. Let's hear what it is.
I don't know. Apparently, there's a
clearly
red
know.
chew now too. In case you're a conservative
A
and you
Republican.
also want some assistance in that department.
Is it for ED?
Male enhancement. Yeah, something
Ah.
like that.
Okay, well, we'll take all the sponsorships we can get. How's that? Let's see here. Let's go. Josh, do you have anything flagged here?
Well,
We do.
here, BB is a mortgage production manager watching from Orlando and asks, aren't the increases in new listings just a seasonal thing around this time of the year? Let's pull up the chart, Jeb. And because here's the important part. That's inventory.
Yeah, go down to the fourth chart.
Fourth
Right
chart.
there. Yep.
Okay. So seasonal, yes, you can see that it does it every year, but we're not looking at the shape of the line. We're looking at the line relative to the last few years.
Sure.
So when we look at that new single family listings, it's, still not as high as some of those gray bars there, but definitely moving up. So it's the relative difference. It's not the fact that they are higher seasonally, because we would obviously expect that, but it's higher than it's been the last several seasons that were also higher than that. Is that a fairly decent explanation of that?
Yeah. And I don't think, again, there's no cause for concern at the moment, unless you're in one of these markets that's getting, that you're already back to 2019 levels and it's continuing to increase, exponentially rather, right? Here in Orange County, you saw the numbers earlier. We're still not back above where we were last year for the high, and and even then we weren't even close to the 2019 levels even at the high last year, right? We're still a couple thousand homes, 4,000 or 5,000, well, not 4,000 or 5,000, probably 3,000 homes short of that number. So we got some room to run before we hit normal. But it's something to pay attention to, right? We talk about real estate being local. You just have to know what's happening in your market so that you can make educated decisions, if you're planning on buying or potentially selling in that case. So
they also followed up with this question, Jeb. Well, price cuts are counted even if the cut is only $1,000. So I don't think we need to look into that. Well, no one measures the absolute level of price cuts. What we can see is it's the highest level of price cuts in 10 years. So price cuts 10 years ago, 8 years ago, 7 years ago also could have been $1,000 or $1. They're the highest they've been in 10 years. I would say ignore that at your own peril. Like Jeb said, is that reason for alarm? No, it's not 90% of the homes getting price cuts, but it's the highest level in 10 years. It tells you something. And again, we're looking at national numbers here. Who cares what the national numbers are? You're in Orlando, know what the numbers look like in Orlando.
No, absolutely. Absolutely. So Brett has a question here. It says, have you noticed sellers paying for closing costs straight up? If not, are they willing to take a higher offer, but then pay the closing costs? So I haven't had any buyers who have requested closing costs on the last couple transactions where I've represented a buyer. And on the listings I've had, the buyers haven't asked for closing costs either. We have had buyers ask for compensation to be paid, in which case that's obviously a negotiation, just like anything else. And for the most part, what I'm seeing is sellers are still paying compensation pretty much across the board. Now, is it the same compensation that was being paid 2 years ago? Maybe, or a year. I guess it was a year ago. In some cases, yes. In some cases, no, right? It's the sellers want to try to negotiate it lower. And that really comes down to, what the buyer and the agent have agreed on and how far they're willing to push it or not push it or what have you. So, but to answer your question, are they willing to do it? I would say in a competitive market where there's multiple offers, probably less of an opportunity to do that. In a market where homes are sitting a little bit longer, maybe not getting much attention, days on the market and are starting to add up, I think sellers should be willing to consider that. It would be my recommendation as an agent representing a seller, if somebody came in with that, yeah, this is something we should consider. Now, whether you build it into the price or ask for it straight up, obviously that's to be determined, and obviously has to be negotiated. But I think there's an opportunity for it because it's becoming more and more of a buyer's market right now as rates stay higher, right? As inventory builds, if demand essentially stays the same, that puts buyers in favor in some markets, but not all markets. So just know your market.
Let me say this, very, very property dependent, even in slower markets. So the best example I have, we have 2 buyers under contract right now. I'm going to say the homes are within 10, maybe 15 miles of each other here in Southern California, within $100,000 of each other in the price point. So very similar price points. One of them, multiple bids, got no concessions from the seller. The other one got $23,000 in concessions at a 715 price point, something like that. And it comes down to, in that case, condition of the property. One is turnkey, ready to go. So an entry-level buyer with 3% down, which there's a lot of them, can go in and get into that property. So they had multiple offers. The other one was in really bad shape. So it needs someone who doesn't have a minimum down, who has a chunk of money, who's going to go in and fix the property. Property is going to be rad when it's done. It is not today. So I would say that's the important measure there. On top of that, again, depends on the market that you're in. We just had a buyer entry level $265,000 purchase in Houston. Listener to the show here was able to get $11,000 of credits. So know your market, know your competition, rely on your realtor to be able to have that conversation with the other side and have an idea of how much interest they have and how many people you're competing with.
We closed one in South LA last week. We didn't ask for credits up front, but we, through the home inspection and everything else, we negotiated $8,500 in repair credits that were used towards closing costs because of the way that it was structured. But there's different ways to get credits in order to offset things. So just know.
And Jeb, to piggyback on what you just said,
Yep.
I have more of the buyers that are saying, hey, we didn't get anything, but we're waiting for the appraisal and the home inspection. We're going to try and negotiate. So definitely a shift in the way buyers and sellers are looking at it, because most of them are getting them. I'm not, is it $2,000? Is it $10,000? I don't know, but they are more keen to ask and more likely to get them. Sellers in most markets with most properties don't want to put the house back on the market.
All right, good stuff. Linda's coming in, my old home warranty rep, just saying hello. So hi, Linda. Thank you for dropping in. Jay, is the Trump administration doing anything to start up the housing market again? So, the Fed, Trump, neither of them necessarily have a agenda to restart the housing market, right? They have different things that they're trying to do that will potentially impact the housing market. But I know Trump has come out and said that, they obviously want to build more homes and open up land and do some other things. And the reality is nothing has happened that's had any real impact at this point. So a lot of the stuff that deals with housing and building and all of these, it's not something that can happen overnight, right? These are things that take time to trickle through the market, which will have an impact on other things that will benefit and or not benefit the housing market, could hurt the housing market. So, any of the stuff related to housing is going to take months, probably a year or so, to really have any real impact on that, is my opinion. So, Josh, if somebody has a 7% interest rate, what rate would they need in order to refinance?
Largely dependent on type of loan and loan size. If you have a $100,000 loan, you probably want it way under 6%. If you have $1 million loan, you maybe only need it to be 6.625, 6.75. So we have a rule of thumb: take 125,000, divide it by your loan amount, and it tells you whether it's worth having a conversation with a lender. It doesn't guarantee you that if take 125, and if it's a $500,000 loan amount, that would tell us that 0.25% would be enough of a move to make it make sense. But I would say it's enough of it to move to have a conversation with a loan officer. A lot of that rate watch, Jeb, that you threw up there, a lot of those conversations on the front end are just, okay, here's where you're at. Here's where the market is. There's some savings right now. Does the savings make sense to jump and do this now, today, or do you want to wait and see where it goes from here?
All right, good stuff. Alvin, is there any way to hire agents to buy a house without signing a contract? Why is it hard to break the contract with the agents? What if you don't like the agent, but agents won't break the contract? So, is there a way to buy a house without a contract? Yes. You don't have to sign a contract with any agent. You can represent yourself. If you do that, though, you risk, potentially doing something that you shouldn't do. So here's what I would say. In order for you to see houses with an agent like me, for example, we have to get something called a BRBC sign, which is a buyer representation broker cooperation agreement that outlines what I, as an agent, expect to be paid based on my services, something we negotiate. And you sign that. Now, there's two types of that agreement. There's an exclusive and there's an inexclusive agreement, or non-exclusive. If it's an exclusive agreement, then that means you agree to only work with me, in which case you decide to cancel, and it's good for 90 days. You can't have these agreements longer than 90 days per the contract. So 90 days is the most it can be good for. At the end of 90 days, you have to get another signed. The way I do them, it further down in the contract, that basically says if you cancel this agreement, which you can cancel as a buyer at any point, if you were part of that exclusive agreement, in theory, you couldn't buy a house for whatever the specified time is, as long as that agreement is intact. So I do it for 1 day. If you cancel with me, if we decide to cancel, we're not good for each other. You wait 1 day, you can buy a house with any other agent. You don't have to use Jeb. Now, some agents won't do it like that. They want to tie you up. Says a lot about your agent in that case. Now, some agents, if they're driving you all over the place, doing different things, expect different things. I get it. I'm not the kind of agent that wants to hold anybody into a contract. If you don't want to work with me, then that's okay. Like, I don't want to hold you to an agreement that says you got to work with Jeb just because you signed something. So talk to your agent, find an agent that does business like that, or however you see fit, or somebody that's going to allow you to cancel it. There are agents out there like that. Not everybody's the same. So just do a little bit of research. If you need assistance, I can refer you to somebody I know, like, and trust. I know people all over the place. I've been doing this for a long time. I go to a lot of conferences. I meet a lot of agents. Hell, I refer a lot of you guys out to other agents across the country that close all the time. So if you need somebody, that link scrolling the bottom of the screen there will get you in touch with me to help you connect with an agent, and or if you want to talk with Josh or a mortgage professional to go through that process. So hopefully that's helpful. Josh, we got Joe. He's new to the show. Question is, he wants to buy his uncle's house. Doesn't have an agent. Well, he wants to buy his uncle's house with no agent. I can wait until interest rates are lower. How long should I wait? So Josh, he doesn't really have a time crunch here, right? He's buying the uncle's house. So timing isn't really an issue, because I'm assuming the price isn't going to change.
Hopefully. This is where I go with this. We preface it by saying we went through the charts at the top of the show. Both you and I think rates are going lower. The question is how fast and how far. And we had a lot of people miss out on the opportunity to refinance last late summer or early fall, because they knew rates were going lower and they were going to wait. If you want to buy the house and you're going to buy the house. You can always refinance. Do it with 0 points. Keep the costs to a minimum. You're going to be able, you or your uncle are going to be able to select the escrow and title company. You can keep those costs down to a minimum. It's like anything else. You want to get ownership. You want to start amortizing that loan. You want to start building equity. You don't have a crystal ball. Jeb and I don't have a crystal ball. So sitting here and going, well, my crystal ball says I should do it in 9 months. None of us have that. And you want to buy the house and it makes sense to do it, just get it done.
There you go. Good stuff. Ahmed says, just want to thank you, both of you guys, for making great content. Just bought my first house. Thank you for being a part of the show. Hopefully you were able to benefit from some of the stuff that we do. We've been doing this, going on 5 years, or I have been. And then Josh came in shortly after that. So we appreciate you guys supporting the show. You guys have helped me get to almost 120,000 subscribers on the main channel on YouTube, almost 6,000 on the Educated Homebuyer podcast channel. So without you guys, none of this would be possible. So we do appreciate you guys continuing to show up and continuing to ask questions. And we hope that you find value in that. So
at some point here soon, Jeb, we're going to ask you guys for a favor. Those of you who bought through us, bought without us, but benefited from the show and you were able to become a homeowner. The best thing for new listeners that maybe they're just scrolling through YouTube and they're like, who are these two doofuses and what are they talking about? To let them know that we have been here for a long time. We do know what we're talking about. We've done real estate, we've done mortgage, and there is helpful, useful information. So Jeb and I will talk about it, but what we would like is just for you guys to share your stories. What did you do? Where were you before you found the show? Where did you end up? And what part did we play in your success in being able to become an educated home buyer and a homeowner?
Good stuff. Bleed green, buying down rates, question mark. If it's a 6.7%, can you buy down a rate to 5.9, or is it better to use the money putting it down on a home? So Josh, what is the most you can buy down? I think it's important to maybe start with a discount point. Typically speaking, how much does 1% get you in rate? Is there an infinite amount you can buy it down? How does that work?
So general rule of
watch the paying.
Yeah. They should watch the podcast. We did 30 minutes on it. But in general, a 0.25% rate buy down costs you 1.1% of your loan amount. But that doesn't say, well, cool, I want to pay 4 points and get 1% lower, because the further you get away from the par rate or the 0 point rate, the more expensive it gets. Lenders don't want loans much below or much above that par rate that they are targeting on any given day. There's this concept of bona fide discount points. So meaning the lender's not making any more. That is the actual cost for the interest rate. Bona fide discount points don't count in the qualified mortgage calculation, but in reality, most all lenders will factor them in one way or the other and only allow you to pay so much to buy the rate down. But bigger question, should you do it? In terms of qualifying for more home, making your home more affordable, making the payment lower, points go much further than buying down the rate. Let's say you're buying a $300,000 home and you have $12,000 to pay 4 points. That's going to lower your rate close to 1%. And if you were to take that same $12,000 and put it down on the loan, it's going to save you about $72. 1% in the interest rate is going to save you a lot more than $72 on the monthly payment. The problem is those points are a sunk cost. So if rates drop 1% next month, you could have refinanced and got that for free, but instead you paid $12,000 for it. So you need to be talking to an expert loan officer that can walk you through, show you the numbers side by side, give you that comparison, and help you come to the right answer for you.
All right, that's great explanation. SF Miners, regular listener here on the show. Would you suggest putting my new home in a trust to protect it and have beneficiaries, or what does the process look like? Absolutely, I recommend that. I think everybody should have their property in a trust. If nothing else, you should have a will. That says what's to happen. But a trust is better. A trust can allow additional things outside that a will cannot. But what does the process look like? There's a couple of ways to do it. Typically, you're going to speak to a trust attorney who's going to ask you some questions and, what you want to happen and where you want it to go. And then all of it has to be set up, right? The other option is you go do it yourself. If you're capable of doing that, LegalZoom, some of these other places have it. I wouldn't recommend doing that unless you truly know the process. But that's more or less how it works. I would say in your market, ask your real estate agent if they know any trust attorneys. Get more than one. Speak to 2 or 3 people. I mean, it can be an expensive process. Here in Southern California, I would say probably going to spend $2,500, $2 to $3 grand to probably put a property in a trust, depending on what your estate looks like. If you have a lot of money, multiple properties, a lot of different things going on, it's going to be more expensive. If you're, husband, wife, maybe a couple of kids or whatever, don't have a lot, it's going to be less expensive, right? The more complex, the more it's going to cost you to do it, but it's definitely worth it.
Let me just say this, Jeb. We're slowly in the process of getting mine done. We have a listener to the show who actually, we helped them with their loan they bought here in San Diego County last year. And he's a little bit more expensive than what you quoted for my situation, which is there's multiple pieces properties of real estate, other things in there. But one piece of advice, I consider myself, I'm pretty knowledgeable. I know a lot. And he said, if you own the property as joint tenants, we need to put it as community property, then put it into the trust. Just that alone, if anything happened to my wife or myself, would be $50,000 to $100,000 of tax savings. So getting an expert that knows how to do it right and knows how to ask you the right questions is more important than getting it done at the lowest price.
There you go. Good stuff. T. Anderson, should I give up my 2.9% to get equity out? And the easy answer is no, but it depends, right? It depends on how much you have financed at that 2.9%. How much are you looking to take out, right? There's something called, what do you call it, Josh? What's the combined rate?
Blended rate.
The blended rate can help you make that decision. But Josh, what's your quick answer on this?
The quick answer is truly throw it in a blended rate calculator. If you owe $500,000 at 2.9 and you want $100,000, you take a second mortgage because the blended rate will be much lower. On the flip side, you owe $100,000 and you want to borrow $400,000, the blended rate will end up much higher and you would do cash out. So for most people that we talk to, the answer is not to cash out. It's to do a second mortgage, even if it's a couple $100,000. For Southern California clients, a lot of people have $500,000, $600,000, $700,000 first mortgages. Even if they want 100 or 200,000, it still makes more sense to do the second.
All right, I'm going to read two different questions along the same lines, and I think it's important to note this, right? Because there are people in here watching that are in Florida, some of these other areas. They see a lot of inventory. They think there's no way that the housing market can continue to appreciate. It's got to slow down, so on and so forth. And then you get comments like this from Francesco says, is it Chesco without an H in there? We'll say Chesco. Why do you guys feel the Northeast housing market has been so crazy? Inventory surplus? Question mark. That would be not a surplus. It would be
deficit.
But I'm going to go on to read the second one that says, I have been a long-time lister. It's hard in the East Coast to get an offer accepted. We have tried 10,000, 15, 25, 50, and even $75,000 above the asking price. Still someone else is winning it over. And he goes on to say, these homes are range between $900,000 and $1 million. Why? Why does that happen, Josh? It's more demand than supply. Question is, why is that happening in the Northeast and not in other markets? Well, some of these other markets, the South, more buildable land, construction goes all year long, a lot less expensive to build. So there's all of these different factors that go into creating inventory and allows it to happen at a more rapid pace, if you will, which again, the more homes you have on the market, in theory, with less demand, the more those prices are going to come down, or inventory is going to grow, or what have you, versus the Northeast. A lot of those homes are older. Our communities have been built out. You don't have this available land sitting in the middle of a dense populated area. And because of that, less inventory. People have 2.9% interest rates like the gentleman that we just talked about. And so that's what creates this chaos in the market. And so we've seen it when we've been looking at inventory. We've seen it when we've been talking about appreciation still in these markets. And it's why we always talk about real estate being local. Understand the market that you're trying to buy in or sell in, because that is going to have a greater impact than what we talk about here on a national level. Yeah. Anything to add, Josh?
No, it truly, the Northeast is unique. High cost to build, not a lot of buildable land, fairly strong economy, older population. So all of those reasons, it's just a tough market.
All right. Thank you, guys. And a lot of you heard what Josh said a moment ago about wanting your stories and wanting to know how we impact it. And you're starting to put some of the stuff in the comments, which we greatly appreciate. The problem with any of this stuff is I don't know if you guys know this, but once the episode goes from live and sits on YouTube, all of these comments that come up right now disappear. We don't see them again, right? Unless we put them on the screen, in which case you see them. But we can't go back and copy any of this stuff and mention your name. If you guys are willing to do this, anything that you're posting in here of how we've helped you, if you're willing to go to the Educated Homebuyer, actually, you can email me directly, or info@theeducatedhomebuyer.com, info@theeducatedhomebuyer.com, and just paste your comment in there with your name. We can use that stuff because we're going to use it and we're going to mention you. And because we can't just sit here and snag these comments, which I wish we could, because it would be the best way to grab it. But I'm going to read a couple of them. Danielle says, thank you guys. Moving into my first home tomorrow. Your content was so helpful through the journey to stay grounded. So we appreciate you saying that. Francesco, we're saying, purchased a home last spring. Show helped a ton. Now they want to refi. Does it make sense to refi? We're gonna answer that here in a second. Were there any others, Josh? No, that'll be good. So there were two of you that mentioned that, as well as somebody earlier. So thank you guys for the positive comments that we've helped. So Josh, to answer that question, to follow up, does it make sense to refi from a 30-year to a 15-year? Worried about losing flexibility from a 30-year payment. So what is your suggestion when somebody wants to do that?
Your worry is my worry. Probably the best example we have is a listener from the show reached out to us during COVID. They refinanced down to 3%. Mortgage broker called them back like 6 months later. Hey, I can get you 2%, or it was like 1.875 on a 15-year. And they did it. About a year later, after rates had already started popping up in the middle of 2022, husband lost his job. They ran up $50,000, $60,000 of credit card debt before he got another job, and it was at a much lower pay rate. And that 15-year mortgage was really putting a crimp in their style. If they had stayed at that 30-year at 3%, they would have been better off. So just make sure the juice is worth the squeeze. There's a pretty big spread between a 30 and a 15 right now. So you're going to get a nicely lower interest rate, but it's going to have an increase in that payment. So for people that are doing that, I like to see that they have more reserves than a standard borrower would, but there's no right or wrong answer. You have to know your situation, how confident you are in your financial future, and also your reserve situation, that you wouldn't paint yourself into a corner with the higher payment.
All right. Good stuff. This is a quick one to answer, Josh, so I'm just going to throw it up here, and then we're going to go back and answer ZL's question. Bankroll TJ says, I know this may sound like a question I should know the answer to, but can you still do a streamlined refinance if your home drops in value? And the easy answer is yes. Yes, you can, because no appraisal is required. And it's not something you should know. I mean, that's not something that I think anybody should know unless you're in the industry. But if you're doing a VA or an FHA streamline, you can absolutely refinance regardless of the value. And I think that's important to know. Anything to add to that, Josh?
No.
Okay. This is a good one. ZL says, saw a property being advertised with a VA assumable mortgage of 2.75%. What factors to consider if this should be looked into? So I think, ZL, where most people misunderstand assumable loans is they don't understand that they have to figure out, I say figure out, and I'll explain what that means here in a minute, the difference between what the current owner owes on that home and what you're buying that home at. So say, for example, the owner of that home bought it at $300,000 and they used a VA loan. They financed 100% of it. And 2 years later, it's now worth $500,000. Again, just making up numbers here. And let's just say they still owe $300,000. That's not the case. They're going to owe less because of paying down the principal. But so there's $200,000 gap there. In order for you to go in and get that assumable loan at 2.75%, that's only on the current balance of $300,000, because that's what's remaining. You have to figure out what the $200,000 difference is. So if you're a VA buyer, most cases you're doing 100% financing. Now, you can still assume a VA mortgage even if you're not a VA buyer. So you can be a conventional loan, you can be whatever. But regardless, there's $200,000 that you've got to figure out how to pay down. Well, you've either got to come into that home, into that purchase with 200 grand for the down payment, or that lender has to allow you to do a second mortgage of some kind to finance that additional amount. So I do know they allow second mortgages behind these. It's just to what extent, Josh, I don't know. So maybe that's where you can jump in.
The second mortgage becomes an issue because how much money do you have to put down? And a lot of our buyers are 3.5%, 5% down. A 95 CLTV second mortgage is going to be difficult and expensive. So you're probably going to have to come up with 10% of the purchase price down. So if it's a big gap, you don't have a big down payment. I know I do a lot of VA stuff. I network with a lot of loan officers that do a lot of VA business. And the most successful ones that are happening are veteran to veteran, because you have someone that is PCS'd from out to a new duty station and someone being PCS'd in, and they've been a homeowner. So they all have equity, and they're able to bring in their equity to buy out the equity of the departing one. Doesn't mean that there aren't any being done by investors or first-time buyers, but Jeb's dead on that the covering the gap is the big question.
Yeah, they're great. If you were buying a home anyway and you had the down payment and you were going to put it down, and you just happened to come across a property that you wanted to buy and they had an assumable loan, fantastic, the best deal in the world. Like you all day you jump on that. The reality is most people out there searching for assumable loans are the people that have little to minimum down payment, at least what I've come across, and they've heard some guru on YouTube or Instagram talk about
You got to go
assumable
find one of
loans
these.
and how easy they are. And the reality is it's not nearly as easy as it's made out to be. Is it doable? Absolutely. But it's a little bit more difficult situation. Farhan says, well, first from Kansas. So thanks for joining us from Kansas. Has a 3% mortgage, but I want to buy a bigger house due to family getting bigger. When do you think I should make the move? So Josh, I had a 2.99% interest rate, and I jumped to a 7% interest rate for that same reason. I was able to take that 7% down to a 6% now, so I've been able to benefit some. But how can you answer
So
this?
how did you decide when to make the move?
It was the right house in the right location for me that made us want to do it. Right. It wasn't any house. It wasn't, hey, we're just going to do this because whatever. It was, we've been eyeing this house. I told, in fact, a friend owned the property, and I said, hey, when you decide to sell it, I want to buy it. And it wasn't an ideal time. I really wish he would have done it when rates were 2.9%, but that didn't happen. And so it was what it was, right? You have to do things sometimes that you don't want to do in order to get what you want to get. And that's the sacrifice that I had to make. And, here over a year into it, it's the new mortgage payment. It's the new norm. I don't sit here and think, God, I really wish just, I beat myself up about it. No, the property's gone up in value and it was the right decision. So it's all personal. You got to figure out what's right for you.
But there's a math equation to it also. You need to get into the game in the sense of knowing what's the price of the home, what's the payment at the new interest rates, what's my current interest rate, and if the payment is $1,400 more a month, you got to ask yourself, can I do it, and do I value it that much? If you got 4 more kids and you're bursting at the seams and quality of life sucks, and you can make that payment, makes it an easy decision. It sounds like you're somewhere in the middle, but get the numbers. Quantify the cost of doing it. You don't have a crystal ball. Jeb don't have a crystal ball. I don't have a crystal ball. So we don't know that there's going to be some magical
what I got,
point.
Bro.
There's not some magical point in the future where you're going to have this level of clarity or confidence. So you have to quantify the difference, the delta between where you are and where you want to be, and then decide, is it worth it?
There you go. For someone sitting on a lower rate mortgage, this is going back to what you mentioned earlier, Josh. Wouldn't a new mortgage today cost more than a blended rate, whatever the mix is? Mathematically speaking, am I missing something is the question.
You're missing that second mortgages are much more expensive than a first mortgage. So if you can get 6.625 on a new cash out loan, which cash out probably a little higher, 6.75, 6.875 on a cash out loan right now. If you're taking a second, it's going to be 8.5%, 9.5%. So no, it literally, like we talked about before, it's a blended rate calculation. So someone that owes $100,000 and wants to take out $300,000, no, the math will tell you that the blended rate is higher with you taking out a second mortgage. So they are the exception rather than the rule, but it absolutely exists, or we wouldn't have said it does, and we wouldn't have told you to do the numbers. Run the numbers and see it for yourself.
Barry has a unique question. Says, pay down the house faster or car loan faster? House is at $600,000 at a 6.25 interest rate, which is below the threshold of 750, which is important to note here. The other thing is got a car loan at $63,000 at a 6.25% interest rate. So Josh, when you see those two, I know which one I would pay down quicker. Which one would you pay down?
The car. There is no tax benefit to the debt on the car. So from that perspective, it's simple. The interest rates are the same. The payment on the car is much higher than the payment on the house. So from that perspective, to me, there's no question. It's the car.
Agreed 100%. Freddie says, if you want to be underwritten by a lender, are you locked to that lender? Should shop lenders before getting underwritten? ?
We're going to do an entire episode on this. You guys hear us talk about shopping for a lender, and it is dangerous to go with one lender. Just talk to them and go, okay, cool. That's what the terms are. Talk to someone on the show who's been watching the show for a year. They bought in the fall when rates were at their lowest and ended up getting a 7.125 rate because they went with the lender their realtor referred and never shopped it. But you guys all seem to hear that we say, shop around, find the lowest rate, find the lowest rate, find the lowest rate. We talk to people every day. Like Jeb sees me walk out of my office shaking my head almost every day at the crazy stories I hear.
This guy's beating his head against the wall constantly.
Because people just do crazy things chasing the world's lowest interest rate. So all reputable lenders should be in a fairly narrow range. Many lenders are not within that narrow range. The only way you find out is by talking to one or two. We talked about it. No one should get their loan from Rocket. But if you want to call Rocket because you like their commercials, because you looked at the app and it's super slick, which it is, cool, go ahead and do that. Get numbers from them, but compare it to a local lender. But whether you've been fully underwritten, in most situations, I would say it is very, very rare. People all will call and ask, well, my realtor said I should get fully underwritten, or I want to get fully underwritten. You go, why? Both of you are salaried borrowers with full-time jobs, and the income hasn't changed 2% in the last 3 years. You got 800 credit scores and $100,000 in the bank. We don't need an underwriter to review that. So the question then becomes, do we have significant questions? Do we have issues here that we're concerned that an underwriter may look at it differently than I do? Or are you working with a green loan officer that just doesn't know what they're doing and needs someone else to sign off on it and put the stamp on it? What I will say is most of the lenders out there that are pushing this, hey, we'll get you a fully underwritten approval. They're high cost direct lenders. They're not very busy because their rates are really awful. So they're going to sell you on this service. We can close the loan and guaranteed 10-day close, underwritten pre-approval. Cool, but does it matter? Does it matter in your situation? Sometimes it does, but it's pretty rare.
Yeah, most of the time we're not closing in 10 days. Most of the time the seller doesn't want to close in 10 days. It's a shock to a seller when they get an offer and then find out somebody wants a 10-day escrow. They're like, holy cow, I didn't know it was going to move this fast. I'm not ready to move. Like, can we ask them for longer? It happens, right? It happens on both sides of it where people want to close fast, but typically speaking, that's not the case.
Yeah.
All right. Josh, do we have another one here? I thought we did. Anyway, thank you guys for continuing. I appreciate you guys showing up early, by the way. 4:30, we came on today because found out my son has a makeup soccer game at 5:30. So we said, hey, listen, we're going to try to make it happen, see who shows up. And you guys have impressed us and come on early.
Jeb, that's
Yes.
a nice spin. You were 11 and a half hours late. They were expecting you at 5 a.m. You were 11 and a half hours late.
Here,
tonight.
I'm going to be very vulnerable right now, Josh. This is vulnerability. If you guys go to my Instagram and you look, my son played soccer yesterday because it rained here last week. We're going to have 2 or 3 soccer games days in a row here. Middle school soccer. My son gets mowed by some kid. He's a forward. He's down. Like he's right outside of the box, right? Taking the ball down. And dude, some kid just comes and out of nowhere, bro, doesn't go for the ball and just plows into him, shoulder into him. I didn't realize how bad it was until I watched the video, right? And which I posted on my Instagram. Once I watched the video, I told him, if that happens again, the very first thing you do is you get up and you punch that guy right in the nose. Like just dead. You won't get in trouble from me. You might get in trouble at school, which then I'll have to go in and figure it out. And now that this is out there, I'll probably even get, but the reality is, dude, like no world in which any kid should do that and not have to pay something for it. Here's the thing. Karma happened. They got a free kick. They scored off the free kick right off that. So it worked its way out in a weird way, but I think a punch to the face would have been better. Just saying.
I'll let you guess what little Josh did in that situation.
Oh, I know what Josh did. Josh tackled that guy. Josh didn't punch him. Josh tackled him. I know what happened. Anyhow, let's see here. So Pinson says here in the OC, definitely a seller's market. It is for the most part. There are still some buying opportunities out there. If you're a buyer's market, it's shifted more so for buyers than anything else. I do subscribe to a report that I send out to clients. It comes out every 2 weeks. It's called what the hell is it called? Reports on Housing, where it talks about Orange County data. So if you are here locally, if you reach out to me and say you want to be put on that list, I'll send you that information every 2 weeks so you can keep track of exactly what's happening in that market. So you can, the real data, or you can show up here because we're keeping the aggregates on the numbers as well and continuing to inform you. But Outbid Single Mom says, my wife wants Outbid Single Moms. And then my wife wants to move into a bigger home with a 7% plus 7% rate. but our home has a 2.5% rate. Should I just leave her? Josh, what are your, we're giving advice now.
Listen, there's a lot more that goes into leaving your wife versus the interest rate and what she wants to do. What if she makes all the money? Then you would be in a tough spot if you leave her. You'd be out on the street. You may not get the house in the divorce. She may get the 2.5% interest rate. So you would have to go get a 7% mortgage regardless. So you got to think these things through. You're being a little rash here, and this would go bad for you.
These are very well thought out. It seems like Josh has thought this out before.
I talked to a lot of people going through divorces.
This is very well thought out. Jerry, have you seen any effects on the Bay Area market from the tech layoffs? Honestly, I don't think Josh or I follow the Bay Area market well enough to give you any real indication.
Resi Club threw out some new charts this week.
Yeah,
Santa Clara was the hottest market in the country.
There you go. There you go. So it doesn't look, I was going to say I haven't seen anything that's negative with regard to the market up there. I do know that San Francisco is starting to come back a little bit because they've seen a dip in home prices, and now people are starting to realize that they do like being in the city. They don't like being in the country, and so on and so forth. And that market's starting to move again, but we will see. Let's see here. We got Sunshine, 3.7% house. Need to sell the house due to a family reason. Should I buy a new house or go and rent? Personal decision, right? It's can you find a house that you want at a payment that you're willing to pay right now? And what does that look like for you? You shouldn't just buy a house because you feel like you need to buy a house. Does everything still line up financially? Do you still have relationship stability, job stability, financial stability, money in the bank outside of the down payment, closing costs, all of those things? Does it still make sense? If it doesn't, that's okay. It's okay to rent, but you got to figure out what your plan is, create a plan, create goals, and really kind of stick to them. So Josh, it's time. I've got to run. Soccer game.
You have to answer one question before we go.
You can actually stay on if you want to stay
on. How are you going to deal with it when Carolina coughs up their unwarranted NCAA bid after getting into the tournament through the play-in, and then you have to watch Duke win the national championship? How's that going to sit?
Duke is not going to win the national championship. I will make a bet here on the air. Duke is not going to win the national championship. And if they do, I'll be pissed. But they're not going to win. I'm willing to make a bet. I'll bet you $100 they don't win. Are you willing to take that bet?
You can go to soccer. I was going to go to soccer, but Steve asked a question earlier, and it's a good one, and I'll answer it. So,
all right. So you're going to stay on?
I'll stay on for a few minutes. So if you guys have questions, throw them up here, because if nothing more comes, I'm going to answer Steve's and head out. All right. He's bouncing. So Steve, sorry, it took a little while. I forgot you had asked this earlier. So using a portion of the VA benefit in Riverside, want to move to Orange County and buy multifamily as a primary. Any reason why a lender won't let me use the remainder of my VA benefit? This is called secondary entitlement or bonus entitlement. The biggest issue you're going to have is that most loan officers will look at you and say, you're crazy. You can't have 2 VA loans, all that and the other. So you want to be working with a VA lender that actually knows the guidelines and knows how to do this. But secondarily, multifamily in Orange County is going to be expensive. So the secondary entitlement will generally not be enough. We have to run the numbers, but it will not be enough for you to be able to purchase the multifamily with 0 down. So I don't know, you didn't mention whether you're planning on putting some money down or not, but I would be shocked if there's enough remaining entitlement for you to buy multifamily with 0 down. If you want to talk about it, use Jeb's link down there. He'll get you connected to me. Do a lot of VA business, probably do 1 or 2 secondary entitlement loans every year. Would love to help you with it and run through those numbers. So Barry, back with another question. If you get a second mortgage for home improvements, is that tax deductible? Since Jeb has left, am not a tax professional. I'm going to give you the broad overview of it, and then you would need to talk to your tax preparer. So up to $750,000 of acquisition indebtedness, meaning the mortgage to buy the home, the interest on up to $750,000 is tax deductible. You also can get up to $100,000 of equity indebtedness. You can take up to $100,000 out of the house, and it can be tax deductible. Varies by situation from borrower to borrower. It can be affected by the alternative minimum tax. So you want to talk to your tax preparer, but in general, you would be able to deduct it in most situations. So if that is it, and we don't have any other questions, I will head out. Steve, reach out. Barry, we will continue to be in touch. Barry's a longtime listener, client, VIP client here of the show. So appreciate all of you guys. Appreciate all the kind words you guys had to say today, the good questions. And again, as Jeb said, thank you for bearing with us as we went at a different time. All right, everybody have a great week, and we will be back and see you guys next Wednesday. Adios, amigos.